Right out of the gate, Exelon's Q2 2026 numbers are out. They posted adjusted operating earnings of 43 cents a share. So that is a solid beat compared to the 39 cents they did in the exact same quarter last year.
Yeah, and crucially, they affirmed their full-year guidance. They are still telling investors to expect between $2.81 and $2.91 by the end of the year.
Right, but something in the report caught my eye. While the adjusted earnings were up at 43 cents, their GAAP net income was totally flat at 39 cents. So why the discrepancy?
Well, the GAAP number, you know, generally accepted accounting principles, that includes absolutely everything.
Right, all the noise.
Exactly. It includes messy, one-off accounting noise or unusual tax items that just don't reflect the day-to-day reality of the business. Adjusted operating earnings strip all that static away.
So you can see the actual cash generating power.
Right. And when you strip the noise away, the core engine generated 43 cents, which is, a pretty meaningful jump.
Yeah, and looking at the earnings waterfall, that jump was heavily driven by updated distribution and transmission rates at ComEd, PHI, and BGE. So they were basically allowed to charge a bit more, but obviously running a grid is expensive, so that new revenue was immediately chewed into by higher depreciation, increased interest expenses, and credit loss expenses.
Yeah, the depreciation is the key there. I mean, when you invest billions into physical assets like transformers and substations, those assets lose accounting value over time, right? So that depreciation hits the income statement. It wasn't just pure profit raining down. It was a balance of higher allowable rates, heavily offsetting the massive costs of carrying all that new infrastructure.
I think the best way to visualize this pure T&D model transmission and distribution is to look at a company like FedEx or UPS.
Oh, that's a good analogy.
Right, because Exelon does not manufacture the goods. They don't own the nuclear plants or the solar farms. They just own the delivery trucks and the roads.
Exactly. The high voltage lines and the local distribution lines. And it's a vital distinction because it completely changes their risk profile. If natural gas prices spike, Exelon isn't taking that generation risk. They just charge for the delivery.
And regulators actually designed it this way, right? To be highly stable through, what's it called, revenue decoupling.
Yeah, decoupling. Think about a normal business. A restaurant wants you to buy more burgers. Historically, utilities were the same. If there was a brutal heat wave, everyone ran their AC, and the utility made a massive windfall.
But if the summer was mild, they missed their earnings target.
Right, and suddenly they didn't have enough capital to, trim trees around the power lines.
Yeah.
Which creates a perverse incentive.
Yeah, you don't want the energy efficiency company secretly hoping everyone blasts their AC just to hit quarterly numbers.
Precisely, so decoupling fixes that. Regulators determine exactly how much revenue the utility needs to safely maintain the grid. If a mild summer means revenues fall short, rates just adjust slightly upward later to make them whole.
And if they overcollect during a heat wave,
they refund the excess back to the customers. It guarantees stable, predictable cash flow.
Okay, so the baseline business is incredibly predictable. But, and here's where it gets fascinating, a toll road is only a growth engine if traffic is increasing. And looking at the demand projections here, traffic is exploding.
Oh, it's massive.
Exelon is projecting roughly 11 gigawatts of high-probability load growth, mostly from data centers. 11 gigawatts, that's essentially 11 massive nuclear reactors worth of new power, and almost 9 gigawatts of that is sitting in the ComEd territory in Illinois alone.
It's a staggering physical reality. The scale of infrastructure required to move 9 gigawatts of power to hyper-dense data center campuses. You can't just plug that into the existing suburban grid.
Right, it would fry the system.
Totally. It requires entirely new high-voltage transmission corridors, dedicated substations, just massive heavy-duty equipment.
Which brings us to the obvious point of friction. If Silicon Valley tech giants are building these incredibly power-hungry AI facilities, I have to imagine the average homeowner in Illinois is terrified. Does the everyday ratepayer end up subsidizing billion-dollar grid upgrades just so a tech company can build a faster chatbot?
That is the exact anxiety regulators have, and it's why Exelon really highlighted their use of TSAs, or transmission security agreements.
Okay, break that down for us.
Well, the Federal Energy Regulatory Commission, ERC, actually endorsed this framework specifically to build a firewall between tech companies and residential ratepayers.
So how does a TSA mechanically build that firewall? Because the report mentions there's, about $1 billion in collateral currently involved?
Yeah, a TSA forces the developer to put massive amounts of skin in the game before a single shovel hits the dirt. Historically, a developer could just say, hey, we plan to build a huge factory, go build us the power lines. The utility spends millions, and then the developer abandons the project.
Leaving the ratepayer holding the bag?
Exactly. Under a TSA, the tech company has to post hard financial collateral, like that $1 billion you mentioned.
Wait, hold on. Let me push back on that. $1 billion sounds like a lot, but these data centers cost tens of billions to build.
Huh.
If a tech giant pivots their strategy in 3 years and walks away, does that collateral actually cover the stranded power lines, or is the ratepayer still eating some of the risk?
No, it's a fair challenge.
Yeah.
But the collateral is dynamically scaled to cover the specific infrastructure upgrades directly attributable to that customer. It isn't just a flat fee.
Oh, I see.
Yeah, it's calculated so that if the developer breaches the contract, the collateral can be liquidated to completely cover the utility's capital outlay for those specific lines.
So it cleans up the planning queue.
Exactly. Only projects with serious financial backing move forward. It lets the utility grow its load efficiently without socializing the cost to everyday residents.
Okay, that makes sense. It forces the tech companies to pre-fund their own driveway to the toll road. But what about the main road itself? Because they're talking about spending roughly $10 billion in capital expenditures in 2026 alone. How are they actually performing for the person living in a standard 3-bedroom house?
Well, the operational metrics for the residential base were actually some of the strongest in the sector right now. Across all their utilities, they're projecting top quartile reliability. And for ComEd and PHI specifically, they're in the top decile nationally.
Top 10% in the country for keeping the lights on, and they quantified that customers experienced 2 million fewer annual interruptions in 2024 compared to 2021.
And we shouldn't treat that as just a corporate vanity metric. It translates to severe economic reality. When the grid fails, it's a massive hidden tax on the economy.
Right. Factory lines stop, restaurant freezers thaw out.
Exactly. The company calculates that this top decile reliability equates to over $1 billion in avoided outage costs for their customers.
But getting to that level isn't free. You have to buy smart meters, replace wooden poles with steel. Are these investments driving everyday bills through the roof?
Affordability is the ultimate tightrope. But Exelon's data suggests they're managing it. Their average customer rates currently remain 19% below the average of the largest U.S. cities.
Wow, okay.
But, keeping the base rate low isn't always enough for vulnerable populations, so they aggressively connect customers to assistance.
Yeah, I saw the LIHEAP mention the Low-Income Home Energy Assistance Program. They connected customers to about $150 million in LIHEAP funding, plus $60 million in direct assistance. But how does a utility actually connect someone to federal funding?
They do it through aggressive data matching. Instead of waiting for a struggling customer to navigate some complex government website, the utility uses its own billing data to flag accounts falling behind.
So they do the outreach.
Right. They deploy community teams, simplify the paperwork, and even integrate the government application into their own portal. They act as this aggressive middleman to pull federal dollars into customers' accounts, which obviously lowers the burden and reduces the utility's bad debt.
Which definitely makes that $10 billion capital spend easier to swallow. But, I mean, you can't just spend $10 billion without getting it approved by state regulators.
No, you certainly cannot.
And that brings us to the rate cases. In this Q2 report, they mentioned BGE, their Maryland utility, filing an electric distribution rate case in July. They're asking for a $156.1 million increase in revenue.
This is the core engine of how a utility grows.
Right. And they're targeting a 10.4% return on equity, or ROE. And I think a lot of retail investors see that and think, well, why does a monopoly get to guarantee a 10% profit margin?
It's a common misconception. It's not a guarantee, it's an allowed ceiling. And the reason regulators allow a 10.4% ROE is entirely based on the competition for capital. Exelon doesn't just have $41.7 billion sitting in a checking account for their 5-year plan. They have to convince Wall Street to give them that money.
Right, because if you're an institutional investor, you could just buy a U.S. Treasury bond and get a guaranteed 4 or 5% completely risk-free.
Exactly. If regulators only offered a 5% ROE, no investor would ever fund the grid. They'd just buy bonds. So that 10.4% is the premium required to attract private capital. And once that capital is deployed and approved, it goes into the rate base.
The rate base, essentially the total accounting value of all the physical assets regulators agree are useful, and they project a 7.9% growth in that rate base through 2029. But asking politicians to charge people more money is inherently risky. What if a state commission just rejects a request?
That is regulatory risk. It is the single biggest threat to a utility stock price. If you spend $1 billion on wires and the regulator deems it imprudent, the shareholders eat that loss, not the customer.
So how do they mitigate that?
Extreme diversification. They operate across Illinois, Pennsylvania, Maryland, New Jersey, Delaware, D.C. They aren't beholden to a single political climate.
The report explicitly states no single jurisdiction represents more than 30% of their business. So if Maryland pushes back, it doesn't capsize the whole corporation.
Right, it acts as a massive shock absorber. Plus, showing up with the receipts, proving your investments resulted in 2 million fewer outages, makes the regulator's job of approving the next round much easier.
But they need the cash to build it first. And looking at the balance sheet, it's staggering. Total debt sits at $52.7 billion. For a retail investor, seeing $52 billion in debt triggers immediate panic. But it really comes down to the structure, doesn't it?
Utilities are uniquely capital-intensive. They're designed to run on heavy debt. The most important metric isn't the total number, it's the maturity. The report shows they've already executed about 86% of their 2026 debt issuances, and their weighted average long-term debt maturity is roughly 16 years.
Wait, 16 years? So is that essentially a defensive play against macroeconomic chaos? Like, if the Fed aggressively spikes interest rates next year, Exelon barely feels it.
That is precisely the strategy. It's like securing a 30-year fixed mortgage. You don't lose sleep over what the central bank does on a Tuesday because your payment is locked in. By stretching maturities to 16 years, they've built a financial fortress. They aren't constantly rolling over short-term debt at the whims of a volatile bond market.
Which gives them the certainty to execute on multi-year projects. And they're going to need it because they flagged between $12 and $17 billion of transmission opportunities that aren't even in their current base plan.
Yeah, that's the shadow pipeline, connecting more data centers, routing offshore wind, building transmission for decommissioned fossil plants.
So pulling all these threads together, the decoupled revenue, the TSAs, the $41 billion capital plan, the 16-year debt fortress, what is the ultimate takeaway for the retail investor listening to this deep dive?
The takeaway is highly visible, highly predictable compounding growth. Management is targeting a 5 to 7% compounded annual growth rate for operating EPS through 2029. And they expect to be near the top end of that range.
So closer to 7%, but they aren't just reinvesting all of that cash back into the dirt, are they?
No, they pair that with a targeted dividend payout ratio of around 60%. So for every dollar of adjusted earnings, roughly 60 cents goes back to the shareholder as a cash dividend, currently growing at a reliable 5% a year. The remaining 40% funds the equity portion of all that grid expansion. It's a textbook total return investment.
It really puts the scale of our daily lives into focus. Just plugging in your phone or asking an AI chatbot a question is supported by this mind-boggling financial web. Behind every wall outlet is $52 billion in debt, 16-year maturities, complex rate cases, and billion-dollar collateral agreements, keeping the machine from breaking under the weight of AI.
It's a modern marvel. But, looking at the sheer volume of data center growth, it leaves us with a fascinating dynamic. The regulated utility model is incredibly resilient, but it is slow. It requires years of planning and public hearings.
Are you suggesting the grid won't be able to build fast enough?
It's the multi-billion-dollar question. As AI models require exponential leaps in power, will utilities be able to clear regulatory hurdles fast enough? Or will we eventually see these tech giants get so frustrated that they bypass the public grid entirely, just building their own private, off-grid power empires with dedicated modular nuclear reactors or private battery farms? It could completely redefine the sector by the end of the decade.
Now that is a thought to chew on. Are we witnessing the final days of the unified public grid and the dawn of the private tech grid? Well, that wraps up our deep dive into the hidden financial forces powering our world. Make sure you follow the show for our daily earnings coverage, and as always, keep questioning what's behind the switch.